Welcome to Financial Checkup 101. Today's presentation is part of a program series we call Empower You. The Empower You program is designed to provide you with financial information that will empower you to achieve your goals and realize financial independence. Today's class will provide you with an overview of the major financial aspects of your life and help you identify areas that you need to learn more about over time. According to CNBC.com, only 40% of Americans have a monthly budget. Where do you fit in that statistic? We will briefly be touching on budgeting today. According to the Employee Benefit Research Institute, only 67% of workers say they feel confident about having enough money for a comfortable retirement. Even more telling, only 23% of workers are confident. So it's very important to start thinking about retirement early. According to Capital One CreditWise survey, 73% of Americans list money as their number one stressor. I'm sure that we can all relate to money stressors at one time or another in our lives, but money worries don't have to be a stress contributor because so much of our finances are in our control. And by feeling empowered to determine your financial future, you can remove a lot of stress from your life immediately. So let's get started. If you want to, today I'm going to help you to take account for where your finances stand and give you some suggestions on how to improve the areas you aren't satisfied with. Let's start by thinking about our financial activities as part of three categories: plan, protect, and grow. Every single financial activity falls into one of these categories, and we'll take them one at a time, break them down. To learn about our finances is something that can be manageable and accountable. So when you're planning a trip, I use Google Maps. You may use something different. So starting your financial journey with a plan is the best way to know exactly where you want to be and how you will get there. The first step to creating a financial plan is to determine your personal financial goals and to anticipate life events. Your financial goals should be concrete goals that you measure, like saving a $20,000 down payment for a home or paying down your student loans or even your credit cards by $1,000. In addition to concrete goals, your financial plan should also take into account life events that are likely part of your financial picture. Those events could include marriage, having children, or a career change. Having these goals and life events documented in the start of your financial plan will help you to align your budget, investment strategy, and savings rate to your future needs. After you've created goals for yourself, you can begin drawing up a budget. As we discussed earlier, only 60% of Americans don't have a budget. In our busy lives, it is sometimes easy to overlook the necessity of keeping a budget that is regularly updated. A budget will not only help meet all of your obligations in the short term, but it will also ensure that you will be able to follow through on those major long-term commitments like purchasing a home, sending a child to college. Your budget should include three major components: your income, your expenses, and savings and investing. Your expenses should include all of the major categories like your mortgage or rent, payments, car payments, but it should also include the things that you do on a regular day, your daily activities like your nails, your hair, golf, whatever those expenses are. Finally, building your savings and investing into your budget. This portion of the budget should include what you are contributing to your 401k. And if you haven't started that, even a simple savings account. Currently, the U.S. personal savings rate is 7.9% of disposable income. Are you saving enough? Do you have a savings account equal to 6 months of expenses in case you aren't able to work? You know, this happened recently with the epidemic, with the pandemic, and we've all had to make changes and make sure that we are sustainable in these terrible times. So when building your budget, though, don't forget to pay yourself. Set up, you know, make sure that you are putting aside at least 10% into your savings account. And you can do that typically through your direct deposit from your employer. So now that you have your financial plan in place, you need to take steps to protect finances. The protect step is important because it allows you to guard your current financial well-being, gain favorable financing terms in the future, protect you against fraud, and give you peace of mind as you accumulate more wealth. You can protect yourself and your family by, number one, maintain your credit worthiness, so important. Number two, guarding against identity theft. Wow, is identity theft growing in these times? And number three, maintaining appropriate insurance levels to protect you and your family. And unfortunately, I think that number three is the one that gets done the least. So the first step to protecting your credit worthiness is to know your number. If you haven't recently obtained your credit score, you should do this immediately. Your credit score will determine if you're able to get a loan and what rate and term you will receive. Many rates are determined not only by your actual score, but what your credit score likely means about your ability to repay your debt. For this reason, it's not only important to know your number, but also know how your number compares to others. The chart above shows where Americans' credit scores fall. Let's take an example of a credit score Let's take an example of what a credit score can mean when applying for a loan. A borrower applies for a loan with a 620 score. So the score falls within the good category, and the credit agency tells the loan officer that 1 in 3 people who fall into that category will not be able to repay their debts. The loan officer takes that information to determine the risk and the appropriate rate for the loan to that borrower. Credit scores matter, so it's very important to know your number. Now that we have discussed how credit scores can impact your finances, let's take a quick look at the 5 factors that impact your score. The first 3 that together make up 25% of your score deal with how long you have had credit, your credit mix. Do you have a good mix of revolving and installment accounts, and the number of credit applications that you have been filed? So, for example, revolving debt is typically your credit cards. An installment loan is like your car that's at a fixed rate and a fixed term. The big 2, which together make up 2/3 of your credit score, have to do with how have you handled your debt? Do you make your payments on time? Do you max out your credit cards? That all impacts your score. Another threat to your credit score is identity theft. We talked about that a little bit earlier. With credit, identity theft affected 14.4 million Americans in 2018. Fraud due to identity theft can take months and sometimes years and even longer to be removed from your credit report, which means guarding your identity is one of the most important things you can do to protect your financial future. The key to protecting your identity is to be vigilant. Be vigilant by safeguarding your personal information. Shred financial documents. Avoid using your social security number when possible. And make sure you have a shredder at home to be able to shred those documents so no one can come in and obtain that information. And even more important, you should pull your credit on an annual basis. Catching identity theft early is one of the best ways to prevent costly errors to your credit. The final step in the protect phase of your financial plan is to check your insurance levels to make sure you and your family and home are covered. An annual review of your home insurance, life insurance, and disability coverage are essential to making sure that you are adequately covered. I mentioned that earlier. Insurance really matters. Make sure your home insurance provides adequate coverage for content of the home and as well as the structure in case of fire or weather event. For renters, your coverage should include adequate coverage for the content of your apartment as well as liability coverage. For life insurance, the general rule of thumb is to have coverage with benefits that would replace between 5 and 10 years of your salary. Your benefits should be close to 10 years if you have significant debt or young children. So important. In addition to life insurance, you want to ensure you have disability coverage in case of an accident. Many people overlook this type of insurance, but you are actually 8 times more likely to be disabled than to pass away if you're involved in a car accident. Finally, health insurance continues to be an ever-changing and critically important benefit. Each year during open enrollment, ensure that you examine your healthcare options and which is the best for your life events. And make sure that if you aren't familiar with that piece of the health insurance, that you're talking to someone that can help you make those decisions as well. Now that you have established your financial plan and you have protected your financial future, it's time to start thinking about how to begin accumulating wealth and growing your financial assets. This is the most important part. To start, we want to go back to the very first step, which is to take a look at your financial goals. Your goals will be the basis for your financial roadmap, which is the plan within your overall financial checkup. The financial roadmap is where you decide the course of action you will take to meet your goals for the future. So you need to start by looking back at overall financial goals to determine what you need to save and invest. Once you have written down your investment goals, you want to set a timeline for these goals. Many goals have a fixed point in time based on things like your retirement age, how long before your child will be going to college, and some goals, you have more flexible timelines that can be adjusted based on the rest of your financial picture. Once you have your goals written down, you need to check in with where you are today. Start with actual account balances associated with each goal by asking questions like, how much do you have saved? How much is your retirement account? How much are you going to need in your college savings account or your child savings account, sorry. Then using your goal timeline, ask yourself if you are on track to meeting these goals by the date you indicated. If you are, you can continue with the current strategy and continue to evaluate on a regular basis. But if you're not, you need to start examining your contributions toward the goal and evaluate where you are using the right financial tool to achieve your goal. So now you have 2 points on the map, your starting point and your goal or destination. Now we need to develop your roadmap to get from point A to point B. This starts with determining if your goals are short-term, 1 to 5 years, or long-term, 5+ years, and choosing the appropriate investment vehicle to get you to point B. For your short-term goals, you want to select a tool that produces a consistent return, such as a money market or a savings account. or CDs. For long-term goals, you can invest in various investment products because over a short-term time horizon, these investments are subject to market cycles. Finally, we want to select the retirement savings plans that are available to you and make the most sense of your situation. If you manage the investments in your retirement plan, you should check your portfolio periodically to make sure you are on track. And that's the main thing, is just staying focused and knowing that you're on track to meet your goal. Excuse me. One of the biggest barriers to investing and saving is that most people don't think they can afford to invest. If you aren't investing smart, start small and work your way to a bigger goal. For instance, with the 10-10 challenge, invest $10 every week for 10 years and you'll have $6,555. This is so small that many people can start here by cutting out a couple of coffee runs or eat lunch in and not go out at least one day a week. If you can invest more, your money may grow even faster. Now let's apply the same thinking to your retirement account. If you can take $10 a week and contribute it to a retirement plan, you could boost your retirement savings plan by an extra $18,481. Amazing, assuming you have 20 years or so until retirement. So the $10 can add up to real money over time, and with a few lifestyle changes, we all can do it. So this truly concludes our presentation, the presentation on the Financial 101, but I want to end our discussion with a few tips smart investors follow. Be reasonable with your expectations. Look for additional ways to contribute more. And lastly, start small if that is what is possible. Review your investments periodically, and that will keep you on track to meet your personal goals. But most importantly, start today. That's the most important thing. As soon as you land that job or you start a new job, or you just make sure that you're saving for the future. And do we have any questions?
Haven't gotten any in the chat yet. Miss Baxter has a question from Wake Tech, and she's wanting to know, other than the Excel spreadsheet, what is good to use for creating a budget?
A lot of times what I'm hearing in the banking industry is the Nerd app really works well. And then, you know, honestly, wherever you bank, they typically will have information for you to do budgeting with their apps or online mobile banking. So that's a good place to start as well. But, you know, honestly, I feel that the relationship, we go to doctors and we look for advice. Use your banker, build that relationship with your banker, and then that's an important relationship to have that can help you meet your financial goals. Great question. Thank you.
Ryan is asking, he said he really likes the investment challenge. I'm gonna try it. Very cool.
Awesome. I'm so excited. You know, as we were putting this information together, it sounds, you know, simple, but it truly works because the most important piece to savings is that you just start it. You plan and you start, and that's the most important piece.
Hi. Can everyone hear me okay?
Yes.
Okay, great. Thank you. Hi, my name is Lisa Jackson. I am a business banker at Fifth Third Bank, which basically means I work with all levels of business owners as they start a business, as they may need to do financing, or as they may need to sell their business. So all aspects of business is what I work with. I will say there's some of my presentation that I'm going to skip over because Michelle has covered sort of the credit history, which is also important as a business owner. So I just want to sort of get that out there as well. What I really wanted to talk about, which is what I find the most, and I understand that I'm talking to some people who may own a business, some who don't own a business, some who want to own a business, some who are employees at companies or at universities and colleges. So bear with me, and if you have questions, put them in the chat, and I think Katie's going to update me on the questions after we finish, and I'm happy to answer anything that I can. But I guess the basic thing that I would like to talk about, because most people will go into a branch and they will open up a business account. One of the things that a couple of the things that you need to be prepared with when you go to open up your account is your articles of formation. So you should, if you're going to open a business, you need to look on the Secretary of State's website, find out if your name has been reserved. If it has not, you need to create your documents within the North Carolina Secretary of State. So you will need to bring that paperwork with you. You'll also want to get a tax ID number, which you will get from the IRS. That's something you'll want to bring with you. And of course, you'll want to bring your driver's license with you. Most banks now will still open accounts in person. A lot of banks have gone to e-signing, but generally that's at the business banking level, not at the branch level. So if you're opening an account with a branch, you're not going to be able to call in and open it online. You're going to have to go in, show your driver's license, and bring in the other people who are going to sign on the account with you. So opening an account, be prepared to open it with a couple $100. That's fairly standard. Business bank, or most banks now have a mobile app so that you can take pictures of your check and deposit those. Or if you have checks that are much larger than, say, $5,000 or $6,000, then you may need to go to an electronic scanner, just depending on the scope of your business. But I like to say that for opening an account, just like Michelle has mentioned, it's all about a relationship. So if you go into a bank and you sit down and you talk with someone, and at that initial conversation you're not feeling comfortable, you may want to shop around, because like everything else, this is going to be an important part of your relationship. You want to find a bank where you're comfortable going in, speaking to whoever's in the lobby, and also a bank that's going to be able to grow with you. Because as you start your business, you may be starting your business as a direct sale, indirect sales, which just means you want to have some place to separate your income, your business income from your personal income, right? And that's fine, but you may be starting off where you have invented, I'm going to I'm going to just think of one business that I know of, someone who makes like refillable soap. So she started off as a business. She went into a branch, but she needed a bank that could grow with her as she grew. So you always want to make certain that even when you start with a branch, there's going to be an assigned business banker. When your sales get to $1 million, you want to be able to go in and sit down and talk with someone who may have a little more knowledge of what happens in the business banking arena. If you need to borrow money more than $250,000, you also want to be able to go in and talk to someone. You may not be comfortable filling out an application online. You may not be comfortable calling an 800 number. You will want to have a face-to-face conversation with someone. That's what I do. I handle clients, well, mine is $500,000, but I handle clients up to $500,000 and over, and $2 million in annual sales. But what I like to say about our bank is, if I'm not going to help you, I'm going to introduce you to one of my branch partners, and they're going to be perfectly adept at taking care of your business needs up until you need a loan over $500,000. So, and when you need a loan, I saw in the when you need a loan, there's certain things that you're going to be expected to provide to a bank. So we're going to need tax returns. You should be prepared to provide 3 years business and personal tax returns. You should be prepared to and know what a profit and loss statement is and a balance sheet. If you're using QuickBooks, you can pull those things off of QuickBooks, but you need to understand what that information is telling you. You'll want to fill out a personal financial statement. You'll want to fill out, and you'll want to have a business plan. I saw in the chat someone asked if they needed a business plan for loans less than $10,000. Typically not, but if you're doing an SBA loan, SBA may always want a business plan that will include 3 years of projections. Now, I will say that the SCORE website, SCORE, has a great outline of how to fill out a business plan and how to complete your projections. I refer people to that website all the time. Additionally, within the University of North Carolina school systems, there is a small business technology center on every single campus, whether it's a state-run, whether it's NC State, or whether it's Wake Tech, or North Carolina Central. Any state-run university, it's my understanding, they have a dedicated small business advisor to help you with your business plans and help you with your projections. They can't loan you money, but they can help you prepare to borrow money. The other thing that I want to touch on within what a lender needs is your personal financial statement. Going back to Michelle's presentation and moving ahead to Rumi's presentation, your personal financial statement is probably one of the most important documents that you can keep up to date, because that document should have on it every place where you have accounts. It should list where your insurance is held. It should list where your mortgage is held. It should list your IRA or any type of retirement plans. And that's a document that you can let whoever's important to you, you can let them know where to find that document, and if something happens to you, they're going to know where to go to look for your money. And so again, someone that's important to you that you trust, don't leave it laying on the dining room table, but make certain that it's in a place where someone who has access and will need to handle your affairs, that they know where that document is. And that is the same document that you're going to use for your mortgage application, although that's not the mortgage application. The information that's on the personal financial statement is the same information you will need for your mortgage application. It's the same information you will need for any type of personal loan or business loan. So I cannot stress enough how important it is to keep that document up to date. And if you need a blank one, please reach out to me, reach out to Michelle, reach out to Rumi. All of us have access to one, and you want to keep one that you can go in each year and update and make changes to. It is a living, breathing document, just like your business plan. Your business plan is a living, breathing document. When you start out, you may think that your ideal customer profile is a 50-year-old woman who, I don't know, wears jewelry. I'm making this up. But as your business evolves, you may find that your jewelry really doesn't apply to a 50-year-old woman. You really want your target market to be people between 20 and 30. So you'll need to update your business plan. And I am giving you very high-level information, so please, ask me questions later. But the important thing to stress is know where to find your tax returns, know how to prepare a profit, loss, and balance statement, and know how to and have a business plan that you keep updated and that you review once a year and take it out and look at it and see if you're meeting your objectives. The other thing that I wanted to talk about on that, is when you're applying for a loan, the bank may want collateral, right? So, because we like to just give you money on a signature, but unfortunately these days we need collateral. Collateral can be all business assets. It can be your private residence. It can be the building that you do business in. It can be your savings account. There's any number of things that you can use for collateral, but most often if you're borrowing, 90% of the loan applications that I receive are for someone to buy a building to operate their business in. So that building is the collateral for the loan. You will be expected to personally guarantee any loan that you receive from most banks these days. So most loans that I do through, I can say honestly, all the loans that I have done through Fifth Third Bank, unless you're a nonprofit organization, we have a personal guarantee on those loans. So, and that simply means you want us to give you money, we need to know that you have your personal assets involved in this and you believe in this business enough to guarantee this loan. we're always going to go after, we're always going to look to the primary source of repayment first. The primary source of repayment is how do you make money. The secondary source of repayment is our collateral, meaning if you have a business and you, I'm trying to think of something, you make the soaps that I used earlier. So you make soaps and your soap business is not selling enough soap to pay our loan back. Then we may have to go after your collateral and liquidate that in order to pay our loan back. Our final source of repayment is the guarantor. Now, keep in mind, no bank wants to own real estate. We have absolutely no desire to own the building that you're operating your business out of. We want you to make your loan payments. Life happens, things happen, pandemic happened as an example. You may have trouble making your payments. The first phone call that you should make is to your banker. And that's why I say it is very important to have a relationship with a banker, so that if something happens, you can call someone and talk through what are my options. And ideally, you would like for that to be the same person. I like to say that in a bank, the more people you know, the more comfortable you are with that bank. I can't think of any one customer in my portfolio that I'm the only person that they know at the bank. There are other people that they know, so that if they can't get in touch with me, they can reach out to those partners, and those partners are able to help them. So we kind of talked over the business. Oh, I know. Keep in mind that all banks are not created equal, right? So for your business loan, so, I'm not doing a Fifth Third commercial. We are in the top 20 banks in the country. So there's almost nothing that a Wells Fargo or a Bank of America can do that we can't do, right? Then you have your regional banks that are more like a First Citizens or well, they're regional today, a First Citizens, North State, some of those banks where they're going to be perfectly able to help you as well with any size business. And some people have their business accounts at a credit union, and that's okay if all you need is deposit and checking and, a credit card. That's perfectly acceptable. But what you do want to be sure of is that you find once you start to grow, and when I say grow, if you've got a business and you're netting $1 million in revenue, you probably need to make certain that you're banking with, and this is no reflection on credit unions, but you want to make certain that you're banking with a commercial bank that can handle all of your needs as far as any banking services that you might need. The other thing that I personally like to address, and I'm going to finish up now, but the other thing that I like to address is have your partners. If you're a business owner, you like making soap. You may not like recording your monthly transactions. You may not like reconciling your bank statement. You may not like doing payroll. Pay providers. Even though it's costing you money up front, in the long run, when you pay a payroll company, you know that your payroll taxes are going to go to the IRS where they need to go, that your state taxes are going to get paid where they need to go, and the workers' comp for your employees, everything is going to be taken care of. When you're trying to manage your business and doing something that you don't like, i.e. payroll, bookkeeping, it just makes it that much harder, and it gets pushed to the side. And where 9 times out of 10 where businesses get in trouble is they don't have good financial reporting. And if you ever intend to borrow money for your bank, for your company, you're going to need good financial reporting. I've touched on a lot of subjects, and I want to be able to give Rumi enough time to talk. So I will take questions if there are any. And I talk very fast. I'm from North Carolina, but I still talk fast. So let me know if you have any questions.
We did get a couple in the chat. The first one is, what's your opinion on student loan debt and paying that off?
Every bank looks at student loan debt differently. I think for the most, here's the thing. There's 2 schools of thought. One is it's cheap money. For most people, it's cheap money, so why am I going to pay it off? But for every dollar you have in student loan, that will affect your ability to buy a house. If you have student loan debt and you have a car payment and you need to buy a house, you've probably reduced your income by $500 or $600 that would go towards your mortgage payment. So you just have to be aware of the amount of student debt you have and how that's going to affect your ability to do things in the future. So that's really my opinion. The one thing I will say about that, pay it off on time. I mean, pay it on time, because a lot of people think, oh, it's just out there, I don't have to pay it. We've got a lot of people right now who are on deferral. I don't know what that's going to look like when they turn that on and they start collecting that payments, but you want to stay on top of it. You want to call them or write them, send them an email, something that you documented where you've been trying to get in touch with them to figure out how to turn on your payment. So don't just think it's going to be deferred forever, because we all know it's not. But I will say that that is a personal decision. Be aware of how it affects your ability to obtain additional credit, i.e., what my husband likes to say, good credit, your mortgage loan. So that's it.
There's another question. Is a business plan needed for loans under 10,000?
I think that is going to depend on the bank. So my opinion is most banks, if you need $10,000, they're probably going to try to move you to a credit card or a line of credit. And that's not a bad thing. It's just that a $10,000 loan that's going to be paid back over 36 months, it's probably going to be more cumbersome for the bank. So if you are looking for $10,000, you probably want to look more towards a line of credit, and or a credit card. Credit cards, most often, some company cards, business cards have to be paid off monthly, so you need to be aware of that. And the thing I like to say about a line of credit, if you can't pay it back in a year, don't put it on a line of credit. So if you need to borrow $10,000 and your bank is saying, I want you to do it on a line of credit, think long and hard about whether or not you're going to be able to pay that back in a year. Because if you have a line of credit and it's not at a zero balance for 30 days during the year, you may or may not be able to renew that line of credit. So just be aware of how you use debt that's on a line of credit, because it is supposed to be for short-term working capital needs, which is less than a year.
I have one more question for you. Does your bank offer short-term class on profit and loss sheets for customers who are new to the process? I guess they're looking for classes.
So they're looking for classes on how to do that. Probably no, we do not. But what I will say to you is there are a lot of resources out there. Go to that SCORE website. They probably have some learning, some classes. LinkedIn Learning also has a lot of different classes. And again, your resources that are free to you is the Small Business Technology Centers at every campus in the state of that's run by the state of North Carolina. So whether it's community college or a full university, they do have those. They do have those resources that are available to you that can help you with those things. And a lot because of one of the great things that's come out of COVID, a lot of learning has gone online. A lot. I think even the library was doing some virtual learnings on business ownership and entrepreneurship. Check also Carolina Small Business Development Fund and the Institute, which is in Durham. They also offer a lot of classes. And I think with that, I want to make certain Rumi has enough time to talk about mortgages, but my email address is lisa.jackson@53.com. And I apologize for not having a presentation for you, but I'm just old school sometimes, so hope that's okay.
Hello, everyone. Can you hear me?
Yes.
Okay,
yes.
Excellent. Yes. Here we go. I'm sharing my screen and hope you can see that. Let me know. I'm gonna switch that to full screen. Can you all see my presentation?
No, we're not seeing it.
All right. Okay. Let me go back into it. 1 second. All right. Sharing. All right. Here we go. Well, first of all, I really appreciate the time. I am going to go through a few slides because I'm a visual person. I am learning by being able to see things, and there are a couple of screenshots that I believe will be resourceful to all of you. And if you'd like to take pictures of some of those screenshots, please feel free to do so. What we're going to cover today is first-time home buyer, but then just a general overview of how to go about the mortgage process. And I really want to echo some of the things that Lisa and Michelle talked about. My number one, if you don't take anything else from this presentation, please find a trusted partner that you could work with. This is my number one and most important tip, because as soon as you start thinking about purchasing a home, you're going to start hearing from friends and family. You got to talk to my guy, no, you got to talk to this guy, or you got to go online. There are a lot of online providers. There are a lot of mortgage brokers. There are a lot of mortgage brokers that actually work for a bank, such as myself. And there is a slight difference, but regardless of who you work with, make sure that they're going to be there for you, not just to take your application, but just to advise you primarily. Our job is to really understand what your situation is, what your goals are, and how to get you there. And that is what we do day in and day out. Don't rely on just an online resource, not to say that they're not good at what they do. But I feel that especially when you're new to buying a home, you should have someone you can talk to. And please go in and be open with them and let them know if you don't have credit, that's okay. If you don't have a whole lot of savings, that's okay. Just let them know truly what your situation is, because if you don't, we don't want to get into the home buying process and run into surprises. So with that said, I am just going to, I'm having some technical difficulties. I apologize. I'm trying to get into my next screenshot here. Bear with me 1 second. Okay, here goes. These are some of the things we're going to be covering. Is owning right for you? Not everyone really is set up to own a home, and that's perfectly okay. But we're going to talk about a comparison between owning and renting a home. Some of the things that you should consider when you're going to purchase a new home, what to expect from the lender, some of the steps to get started to get you prepared, and then I'm going to take questions at the very end. So I'm not going to take too much of your time, because I feel the questions and answers will probably just cover some of the things that you guys want to talk about. But here we go. Advantages of owning your own home. As you all know, the opportunity to build equity, especially in this market, is very important, because the prices in this area are skyrocketing, which is a great thing for the homeowners. You know, when you're going into buying your own home, again, this is why it's very important to have someone beside you that can guide you through, because going into this market right now to purchase a home can be challenging. So you want to make sure that you have everything in order. Additionally, gain sense of community, you know, get into a neighborhood that you enjoy, and you can communicate with your neighbors, and, you know, kind of join in an area that you want to be in long term. You can free to decorate, landscape, do whatever you need to do to customize your home to your likes, and not be dependent upon landlord. And there could be some potential tax benefits. The downside, or I guess I should say, the good thing about renting is that it gives you more flexibility. There may not be any tax benefits there, and you're not going to gain equity. But at the same time, it's a more temporary solution, or sometimes people prefer to rent for life. And either way is okay. There's nothing wrong with just being a tenant. Some people just don't like the maintenance. And these are some of the things that you really need to consider when you go into buying a home. Home maintenance can be costly, and you may want to consider purchasing a homeowner's insurance, so you have that available should something go wrong. This is a simple comparison of 7-year scenario of purchasing versus renting. Now, I'm not sure how many years ago this was actually put together, but it will just give you a brief overview that technically owning your own home has savings, not just in a upscale market that we are right now because the prices are, going up. But in general, you will save more money by owning. What are some do's and don'ts into buying your home? This one says, show signals that you're a serious shopper. I would say again, number one is just make sure that you have someone that will guide you through the process, because no, there are not two customers that are alike. Everybody's financial situation is very different. Everybody's financial background is very different, and there might be two people that are the same age, but I guarantee you they don't always have the same buying power. So having someone that can evaluate where you are and where you need to be is very important. So to me, that's number one. Make sure you have someone beside you, and speak with your bank. That's another thing that I would say, because oftentimes people, when they start thinking about mortgage, they go to, again, friends and family, somebody that's been recommended to them, but they don't consider going to their primary bank because oftentimes you already have, financial history with that bank. You've been their customer for however many years. They have records of you keeping your accounts up to date, and so on and so forth. You may even have a car loan or two. So consider going to your bank and having a conversation with their mortgage department as well. My next slide is talking about do's of buying your first home, and not all mortgages are equal. There are certain programs that can help first-time home buyers. There are certain programs that can help if you're trying to buy home in a more remote area. There are certain programs that could assist you if you're a veteran, but your mortgage lender will be able to guide you through the process. Typically, you got to think about how much money you're putting down. You got to think about if you have enough money to put down for closing costs. You got to think about who your real estate agent is going to be, and that is actually my next slide. Having someone that could guide you through the process and help you on the buying side to represent your interest. Obviously, the mortgage lender will do everything they can on the financial side, but you want to have a trusted real estate partner as well that could guide you through the actual transaction, making sure the home is what it is, making sure the inspection is in place and everything else, and it comes in timely manner, because you obviously want to close on time and not have issues. So this is where the real estate agent will be able to guide you through. And if you don't have somebody in mind, often we work with very many real estate agents in the area, and we can recommend real estate agents to you if you'd like to interview those. Next thing, making sure that you actually have home inspector to review the property. In a competitive market like today, oftentimes people feel that they need to rush through the process and skip certain steps. When you're a first-time home buyer, please don't do that, because although it might be quicker and easier just to say, oh, we don't need an inspection, you don't know what unexpected problems there could be with the home. And you want to make sure there's no structural damage. There isn't anything really major with the home, that it's not very visible, because you can always catch the problem. So you want to make sure that a licensed inspector comes in and inspects the property. And if something goes wrong throughout the transaction, you still have time to back out or actually get an estimate and work with the seller on correcting the issues. Do's and don'ts of buying a home. There are a lot of don'ts here on the list, but my main thing is, once you decide to go into the mortgage process and you have the conversation with whoever your lender is going to be, make sure you don't make rash financial decisions in between the process, such as buying a car before your mortgage loan closes. Make sure you communicate with your mortgage originator and you let them know, hey, this is what I'm thinking. Is it a good time for me to do it now? Typically for a purchase, it takes about 35 days. Make sure that your home transaction does go through before you make, big decisions and big changes with your credit. There are some examples here of debt to income ratio, but we talked a lot about credit today. I'm not going to go into too much, I'm not going to go into too much detail because I feel like every mortgage lender will be able to guide you through a transaction and let you know what an acceptable ratio is, and in your case, just explain to you what to do or not to do. Mortgage costs. There are some mortgage costs with purchasing a home. You're going to have a homeowner's insurance. There are some processing fees, title fees, application fees. So again, every lender has different fees. I'm going to just mention Fifth Third's fees, so you have those as a comparison. We do charge a $395 application fee and $750 origination fee. And those are the only two fees that the bank does charge, and those are very competitive in the market. Typical closing costs in this area are between $3,000 and $4,000. So just this is just as a ballpark for you to kind of have an idea of what those run. There are different programs, like I mentioned. Fixed rate is the most obviously known way to go because it gives you peace of mind, and we do offer 30 years, 15 years, 20 years, 10 years. There are different obviously programs that you can go with. Adjustable rate mortgages, those were very popular a while ago. We don't do a ton of those. There are federal housing administration programs as well for people that are first-time home buyers. They may have some issues with their credit. Maybe their credit is not as strong, and VA loans for our veterans. But there are many other programs that your mortgage lender can talk to you about. What to do, and this is probably a good slide to take a picture of. Of course, pay your bills on time. Sometimes we see people with disputes that, for example, something happened with their credit card and they decided not to pay their monthly bill because they are in dispute, right? And this is something that will absolutely affect your credit. So one thing that I would always tell you is, even if you pay the minimum balance, make your monthly obligation and then go into the dispute process, because if you miss a bill, it's going to reflect on your credit and there's nothing that they can do about it. Even if it was a dispute, the credit bureau has to be notified that you missed the payment. So make sure you always pay your bills on time, whether you use bill pay or another way of doing that. Make sure that you're not late, because if you're 30 days late or more, it will reflect on your credit report. Inspect your credit report. Michelle talked about that as well as Lisa, I believe. Save for down payment. This is important. If you can put at least 3% down on your new home, that is typically the best way to go, because that will give you a little bit more flexibility with your finances. Gather your tax returns. Make sure you have at least 2 years of history of obviously tax returns, W-2s, pay stubs, and my next slide will show a little more detail on that. Collect your bank statements. You're going to need those. Include your savings accounts, investment, retirement, whatever else you have. And sometimes people, when they complete the application, they don't complete it on 100%, thinking, oh, well, I have a retirement account and it's not really going to matter, so I'm not going to put it in. For us loan officers, the stronger you are as a borrower, the stronger you will look in front of the underwriter. So we want to make sure that all of your assets do reflect on that application. So please put anything that you do have put to the side, even if it's a small amount, it's still going to show that you are saving and you have been preparing for that process. Determine how much house you can afford. This is very interesting because there are very many calculators online that you can go in and actually plug in your numbers. They're not going to pull your credit or anything, but you can actually play around with the numbers and see what you're comfortable with. We do have one on our website at www.53.com. If you go under borrow mortgage, you're going to see halfway down the page a mortgage calculator. One of them, one of those calculators does talk about how much house I can afford, and I'm just going to challenge you just to go in and play with the numbers. You don't have to put any personal information or anything like that, but it will give you a good overview with your income of what you can afford. And this is the other slide that I encourage you to take a picture of, because these are some of the documentation that we may ask of you when you apply for a mortgage loan. So I'm going to give you a couple of seconds there just to take a picture. And that was practically all that I wanted to cover today. I want to give you an opportunity just to ask questions. This is my information. Feel free to reach out with any questions or anything that I could do to help.